Online application. An unmortgaged expert will be dedicated to you every step of the way.
Call or go online. Save your money.
Closed captioning of this program is brought to you in part by BNN, Business News Network, celebrating 10 years of outstanding business news coverage.
BNN has been on the air for 10 years, and all this month we are looking back at the stories that move the markets. Some of the biggest gains over the past decade were seen in the global commodity markets, oil, gas, gold, you name it.
And Canada, of course, reaped the benefits of that. The high price of oil drove the loonie to record highs, and bidding wars broke out over Canada's mining giants. Here with another BNN flashback is Michael Kane.
It was the biggest commodity bull run in a generation. Some dubbed it a commodity supercycle that could last a decade.
You can't imagine how much money is going to be made in commodities.
In 2005, copper prices rocketed to $2,000 a ton. A year later, the prices had doubled.
We're in a rising copper market, and it's a safe bet.
In 2006, aluminum hit its highest level in 17 years.
We expect demand to grow more than supply, and again, there should be strong pricing on the basis of that.
The markets were driven by a 1-2 punch, a lack of new supply, and China's unquenchable thirst for raw materials.
Supply hasn't kept up with demand. Then you add an additional demand component coming out of China. So you really have, perhaps in the last 10 to 20 years, a supply shock. Now we're seeing kind of a demand shock.
As commodity prices rose, so did Canada's fortunes. The Canadian dollar tracked resources higher. The TSX surpassed the 15,000 mark for the first time in its history. And investors made billions in the bidding wars over Canada's mining giants.
I am a strong proponent of the stronger for longer, and I think that on a long-term basis that prices are going to stay higher for a long period of time, and certainly higher for the next 10 years than they have for the last 10 years.
Brazil's Vale bought Inco for $17 billion. Switzerland's Xstrata paid $18 billion for Falconbridge. And the biggest deal of them all, UK-based Rio Tinto bought Alcan. The price tag, $38 billion. The world's appetite for Canadian mining companies was as strong as the market for the commodities themselves.
It can go on as long as we don't get new capacity reopening and as long as we don't have a global recession.
A recession did come, halting the commodity bull run in its tracks.
For more on that commodity story, we are joined by Bart Mellick. He is a global commodity strategist at BMO Capital Markets, joining us live from the TSX. Bart, nice to see you this morning. You were covering metals, mining, commodities all through that period. Is it the appropriate term to call that a bubble when we were getting to the peaks in all those different prices?
Well, you know, I'm not sure it was a bubble per se. To a great extent, prices reflected the supply-demand realities for many commodities, including copper. What we had is we had many years of deficits, and essentially you had a market that was rationing supply, and the only way you could really do it is by price. You needed price destruction in order to balance supply with demand. There are some who say in the energy market in particular, there was a bubble where prices went significantly above where they needed to go. But, you know, I would say that with every price, there was somebody on the other side. And much of the moves were essentially driven by risk management drives by consumers who were afraid of prices moving up even higher.
Well, we had a whole confluence of things that got us into this kind of commodity bull market. The most interesting thing is what is going to happen on a go-forward basis. You talked about supply constraints before. We have price destruction. What's the outlook now? I mean, we're going to see more of the same. Supplies now coming on. How are we where are we in the supply-demand situation now?
Well, at this very moment, most commodities are in a surplus situation, and that shouldn't be a big surprise. We just had the sharpest decline in economic activity since the Great Depression, so demand has come off. There was a bit of a lag with supply, but you know, this time around, supply has come off as well. So for the next couple of years, we're not going to see these great pressures. Maybe a year we have a fairly safe year going forward. But beyond that, if you assume that demand will continue to be quite strong and coming from countries like China, which are building out their infrastructure and shifting their economies towards consumerism. You have India, another 1.2 billion people or so coming into the global market, also building a middle class, needing to spend infrastructure. We see the demand side of the equation as being quite robust going forward. And of course, you have, normal demand from the G7 or the Western countries, so-called.
What about scarcity of supply going forward? Which commodities out there are you concerned with in terms of scarcity?
Well, I think certainly concerned about copper. There are an awful lot of projects that are coming on stream imminently. Projects like Pebble in Alaska aren't going to be, in production who knows when. We have mining grades or ore grades depleting all over the world. We've seen a reduction in capital expenditures for long-term investment in mining generally. There are very limited amount of projects out there, and demand is seen to be quite strong. So copper is one. Oil certainly is another long-term, where the new finds that are out there are expensive. They're either, some sort of a tar sand structure like Canada's bitumen project, or very deep underwater reserves that are quite expensive. And we've seen in the energy sector as well, the last data I've seen, a 21% decline or so in expenditure. And we're not seeing the type of investment for the long term required that would balance the market at a cheaper price. We've seen OPEC and others just pull back after this recession, and those are going to be issues going forward.
One of the things, this is maybe a bit simplistic, but we always talk about investors want to come to Canada because we have all this stuff. But hasn't a lot of this stuff been bought by foreigners? You think of Alcan, Falconbridge, Inco, for example. Where is the Canadian ownership of some of this stuff?
Well, there's, ultimately, any company that operates these assets is operating in Canada, paying Canadian taxes, paying Canadian employees, and investing in Canada for the most part. Quite often in large mining projects, most of the cash is reinvested anyway. So it tends to stay within Canada, and I'm not so sure it's all that relevant where the ownership lies. But, never mind the established projects. We're seeing a myriad of domestic projects, smaller development projects, exploration projects that are coming into fruition, that are certainly benefiting, will benefit Canadians, and quite often, most times, they're Canadian-owned. In the mining space, Canada and Canadian companies are the most aggressive and most successful in the world in putting new projects together, and that includes in Canada and around the world. So we own quite a bit of stuff outside of Canada as well.
Bart, thank you very much for joining us today. Nice to talk to you.
My pleasure.
We're joined by Bart Mellick. He's a global commodity strategist at BMO Capital Markets.
Of course, next week we will continue to review what's going on from a 10th anniversary perspective. But after the break, we've got more Market Morning and part 2 of Marty's Wei-Zhang Tang interview. Stay with us.
Are you one of the millions of Canadians who suffer from the pain of arthritis?
I'm one.
Well, Aleve brings you some good news.
I like good news.
Just one Aleve pill has the strength to relieve arthritis pain, stiffness, and joint pain for up to 12 hours. So you can do the things you love to do without worrying about nagging pain.
That's great news.
And the best news of all, Aleve is now available in Canada.
Welcome to Canada, Aleve.
So try new Aleve and discover the good news it can bring to your life. New Aleve, one pill, 12 hours strength, 12 hours length.
1,591 horsepower. 37,600 RPM. 36 airbags. 6 top safety picks. And now, one last chance to get up to $10,000 in cash incentives with cash purchase of remaining 2009 Acura models.
it make sense if car insurance rates were based on skill and experience? That way, the better drivers would get the better rates. So who are these better drivers? Drivers like you, 50 and over. Because your years of experience and good judgment make you a better driver. If you're 50 or over with a clean driving record, you are eligible for the Experience Advantage through Great Power. To find out how much Great Power's Experience Advantage could save you, call us at 1-866-473-9214. Great Power's Experience Advantage could save you up to $400 per year on your car insurance. To find out how much you could save, call now. Insure your car and home with Great Power and save even more. Call 1-866-473-9214.
You are watching BNN, Business News Network, celebrating 10 years of outstanding business news coverage.
Small decline right now on the S&P TSX Composite, 11,496, but still several hours to go to the end of this trading day. Welcome back. Thank you very much for sticking with Market Morning. I'm Marty Say.
And I'm Francis Horodelsky. We got lots of market morning coming up, including the second part of the interview that Marty had with Wei-Jiang Tang. It's quite interesting, the whole Ponzi scheme. We're also going to be talking about the new Canadian General Freight Index with, we're going to talk to Doug Payne. He's the president of New Logix. They create this, this new index.
Sort of like the Baltic Dry Index, only for Canada. And before we get to all that, though, let's get you caught up on all the headlines.
This business update is brought to you by Walk a Mile in Her Shoes, Toronto's Walk to End Violence Against Women. October 1st, visit walkamiletororonto.org for more.
Here are the top business stories we're following this hour at BNN. Wei-Jiang Tang stands accused of running what could be the biggest Ponzi scheme ever in Canada. In June, the Ontario Securities Commission laid 12 charges of fraud and other alleged stock and trading violations that could result in maximum penalties of 60 years in jail and a $60 million fine. In an exclusive interview with BNN, Wei-Jiang Tang told us he knows what investors need to succeed, and he also adamantly denied he was running a massive Ponzi scheme.
Ponzi people do not know the market. I know the market so well. You ask anybody in the market who know better than me, you know, who know where the market moves, who call the market. You see my website, I know so much, you know, timing and so much things about the market and so much timing of the market. Nobody else comparable to me.
Strength in the auto sector helped push Canada's wholesale sales well past expectations in July. StatsCan says wholesale sales climbed 2.8% to almost $42 billion. It was the second straight monthly increase. 5 of the 7 trade sectors posted gains. The Commissioner of America's Federal Housing Administration says the agency has enough money to cover future losses. He says that means the FHA will not require taxpayer assistance or new congressional action. In order to maintain government-mandated reserves, the FHA says it will appoint a risk officer as well as make changes to its credit policies. The agency has guaranteed about a quarter of all U.S. home loans made so far this year. The Wall Street Journal is reporting the U.S. Federal Reserve will soon have a hand in setting pay levels for thousands of bank employees across America. The move would mark the first time government regulators would participate in compensation decisions, which are normally the domain of the bank's boards and executives. The plan would allow the Fed to reject any pay practices it felt encouraged excessive risk-taking. There are lots of laughs at the Wharton School of Business when former Merrill Lynch CEO John Thain said he should have shopped at IKEA. In a speech at the University of Pennsylvania School, Thain said that he decorated his office in the Merrill style, which was very, very nice. He said he's sorry he did that, and if he had to do it all over again, he'd furnish the office in IKEA. The remark was met with laughter and applause. Thain was accused of overspending on a renovation just as the brokerage firm was on the brink of collapse. And that is your business update from Business News Network. On the other side of the break, your full market update. Stay with us.
I'm not a captain, but I can show you a better way to fly. It's called avioning. Look at all these seats. Oh, but I'm sorry, sir. Your card only allows access to a few.
But with the RBC Avion card, your points are used to buy seats on any flight.
So the world is your oyster. Shuck away, my friend. Shuck away.
Find reward seats on any airline. Avioning, the easiest way to fly.
The all-new 2010 Mercedes-Benz E-Class may say that you've arrived. But that doesn't mean you can't enjoy getting there.
Copper Mountain's mining project is an open-pit porphyry copper mine just outside Princeton, British Columbia. On July 30th, Copper Mountain and Mitsubishi Materials Corp. signed an agreement.
They did advance us $28.75 million. And with those funds, we did start construction earlier this spring. We finished the feasibility study in 2007. More recently, we were able to add the 2008 drilling results, and they increased our resources up to about 5 billion pounds of copper. And our initial focus has to be to get the mine in production, producing normally 105 million pounds of copper per year by the first half of 2011. We've had some very exciting results from geophysical studies, and these have given us targets that warrant a lot more exploration drilling.
This market update is brought to you by Hampton by Hilton. At Hampton by Hilton, we love having you here.
Markets turned into the red in Canada. You'll be able to see it on this intraday TSX chart. I'm showing we're down about 45 points or so. We tried to climb into the green at the open, but we're sliding down a little bit. Materials leading the way to the downside, healthcare to the upside. Here are some of the laggards first. Let's look at the weak stocks, mostly golds and oil. You can see CP Rail also down on the Stifel Nicholas sell rating that came out this morning. On the leadership side, we have the financials, some of the financials, including Manulife, following that presentation they did at the Scotia Summit yesterday. RIM must have been overflow from the U2 concert here in Toronto yesterday. There were a lot of blackberries there. SXC Healthcare, despite the fact that they priced that issue at $41.50. That's a U.S. number. This thing is on wheels. They couldn't get enough of it. They had to bump the offering. In the United States, let's look at those markets which are still in the green. Well, actually, the NASDAQ and the S&P just now slipping into negative territory. The Dow still higher, largely because of two upgrades. One was Chevron. The other was Procter & Gamble. Citigroup going to buy on this name. They have a $66 target. They are commenting on the fact that they think P&G is just going to be that much more aggressive in getting share. And some of these consumer staple stocks have lagged the market. You may see some more upgrades. But P&G is the one this morning, and that is your Market Minute on the Business News Network.
And the federal finance minister right now is set to announce potentially a consultation period that may lead to the elimination of all remaining import tariffs on machinery and equipment. At least that's according to a report in the Globe and Mail today. Now McGee has been taking a look at this story now.
Yeah, we do not have confirmation yet from the finance minister. I called the finance minister's office. They say they've seen the report, but right now they have nothing yet to announce. But here's what the Global Mail is reporting. The Global Mail is reporting that the finance minister will announce a consultation period that will last about 7 weeks that will look at the possibility of eliminating all remaining tariffs on machinery and equipment. And this, of course, would have potentially a positive impact on companies, for example, that deal in the auto parts sector, printers, sawmills, any industrials that really have to import parts as part of their building of machinery. And according to the Globe, in the announcement that the minister will make, that the minister is saying it will give a short-term boost to the manufacturing sector and also give Canada a long-term competitive edge.
How expensive are these imports for Canadian manufacturing?
I spoke to someone at Export Development Canada. It does not seem to be a huge issue right now, primarily because of NAFTA. Canadian manufacturers aren't really subject to any massive imports currently from Mexico or the US because of NAFTA. The export development person told me it's more to do with over-the-pond imports. So if Canadians are importing stuff from Europe or Japan, then potentially, for sure, there'll be some savings. I should also note that the minister has already made some progress on this front. In January, the minister eliminated about $440 million worth of import tariffs that were remaining at that point, and reportedly the value of the remaining import tariffs that may be eliminated is only about $300 million. So it doesn't seem like it'll be a huge deal in terms of dollars saved for Canadian manufacturers, but a little bit is a little bit, I guess.
Interesting coincidence that the G20 just happens to be coming up next week.
It is coming up next week, and we should remember as well that the US caught in a little bit of a trade spat with China over imposing 35% tariffs on the import of Chinese tires. So potentially, I guess, we can ask some of our guests about this. Does this put Canada in a more favorable light vis-a-vis the US next week's G20 summit? The WTO had also recently complained about policy slippage amongst the G20. In other words, people, getting a little looser on trade or becoming more protectionist, I guess, essentially. So does this put Canada in a more favorable light vis-a-vis the US? We'll ask some of our guests that later today.
All right, thanks now.
Thanks, guys.
We're going to stick with trade again just for a little bit longer now. Right now there is a new index just been created to measure how much it costs to transport items across Canada by road. It's called the Canadian General Freight Index, and it was launched this month. For more, we are joined by the company behind the CGFI. It's Doug Payne. He's the newly appointed president at Nulogic. Doug, great to have you in.
Thank you.
Now, explain this index. First of all, where is the data coming from? How do you calculate it?
Well, the data is coming from our database of information where we have over 2 million transactions a year, and which provides about $1 billion of freight spend. We've taken that data, working with Dr. Ellen Shape, to statistically validate the accuracy of the information to be able to produce this to the marketplace.
And before we go into what it includes or doesn't include, do we have a historical data on this, or this is a go-forward?
We've gone back to January of 2008, and there's been some really interesting trends that we've seen.
Oh, okay. Well, let's talk about what's in it and what isn't in it, because I understand it doesn't include liquid bulk, dry bulk, forest products, and maybe some specialized freight. Why not those things?
Well, the marketplace, the predominance of the marketplace is dry goods moving across the country. So that's really what we focused in on, to be able to have enough statistical information to make this valid.
Okay, let's talk about the trends then. What are you picking up? So we don't have liquid bulk. Liquid bulk, right. Presumably chemicals, perhaps even oil and gas. No dry bulk. Forest products aren't included. Stripping all those out, what's emerging?
Interestingly, in going from the first 7 months of 2008, we saw transportation costs rise by 14%, over 14%. When you drill down underneath that, 7% of that was created by the base freight rates itself, but 44% of that increase was driven by fuel surcharge. In August of 2008, you started to see the decline in the slowing of the Canadian economy, and that drove the rates to stabilize, but fuel surcharge to come down. Interestingly, if you take from July of 2008 up to May of 2009, the rates have actually dropped by over 13%. Which is a pretty big number.
And how much of that is fuel then, or surcharge?
Predominantly, that is driven by fuel, but if you drill down a little bit deeper and you look at from the domestic freight rates have dropped about 4 to 5%. And if you look at the cross-border rates, they've actually dropped somewhere between 6 and 9%. Part of that is from the weakening Canadian dollar, and the other part of that is through freight increases, predominantly in the truckload sector.
Now, how sensitive is this index to swings in the Canadian dollar versus the U.S. dollar?
Well, I think it definitely has a play, in particular in the cross-border business. And the other impact that it has is the manufacturing and the volume of freight that is moving back and forth and balancing of equipment in the asset side of the game.
So when you look at this index, there's two things that can drop out of it. For one, those people doing the shipping, or companies doing the shipping. So am I right in that in the last 9 months or so, their revenues are declining by that level?
Absolutely.
Is that true?
Yes, that's
and then the other side is the cost for me as a shipper.
Right.
So that's a good thing.
Yeah, and you know, I mean, the idea of